Buy, sell or rent your property with Century 21 and you could win a brand new 2-bedroom apartment on the Sunshine Coast in Queensland. Visit c21win.com.au for your chance to win.
Welcome back to Your Property Empire. Well, joining me on the show tonight is Effie Zahos, editor of Money Magazine, and we've just been joined by Charles Tarbey, chairman and owner of Century 21 Australasia. Now, we had a viewer question from David in Sydney via Facebook, and he asked, in the current market with banks tightening, once we've created equity to an LVR well below 80%, is it still possible to cash flow your lifestyle on the equity growth each year? Now, Charles, you'd know the pre-GFC days of low-doc and no-doc loans where you tick a box and they lend you 80%.
I know of the days where...
The good old days.
You borrowed... Some people borrowed the deposit to start with, so it was almost similar to what was happening in the US, but this is going back in the 70s and 80s. I think the biggest issue is not how much equity you've got now, it's the affordability, and that's what the banks and APRA have really brought to the table. No longer can I just go out and... use my equity to borrow money unless I can demonstrate an ability to repay, and that's the biggest change I've noticed. So equity, although when we talk about people going out and revaluing their properties and going out again and buying another based on the equity, it's not quite that simple nowadays.
So as Charles says, it always used to be LVR, that was the biggest thing before, whereas now it's serviceability. So how tough is it to get money out of the banks?
Oh, I'd have to say it's both LVR and serviceability. Look, right now, you could get an equity access loan, the maximum would be 80%, so long as you can service. So, yeah, you're absolutely right. There are two things, serviceability and your equity that you do have in there. Probably most people may find themselves in a situation where they're probably about 2.5 years ahead in repayment, so they've got that redraw facility. That's the good news. So I'm not talking about first-time buyers that have just jumped in last year and so on. They're going to be doing it tough, and they're the ones that are feeling the mortgage stress at the moment. So if you've got that redraw facility, no questions. They're not going to ask you what it's for. You can go blow it on whatever you like. Wouldn't advise that, obviously, because we're looking at rates, as we just discussed before. We're coming a turning point with yields on bonds going up already. That's a good indication that we can expect interest rates to rise. I probably wouldn't be wasting around with my equity at this stage. I'll be paying my debt down, trying to get it at a sensible LVR, well below 50 if you are wanting to draw out. And I absolutely agree with you. Then your next property is a bit harder. It is harder.
Even though you can get the serviceability and the equity, there are not too many places you can buy where you're going to get capital growth at the moment, because most of that's already come and gone, and you're taking the risk of going further and further out of the capital cities. And when the market changes, invariably it does, it's usually the top end that suffers and the discretionary spending in the outlying areas that cop it most first. So
and the yields aren't as strong too, and if you are borrowing for an investment loan, you are relying on rental to supplement your serviceability, and that's not that strong at the moment. So while we can all talk and us journos are great and saying buying an investment property, it's not as easy and the risks are higher.
Now, obviously, especially in the old generation, is taking your equity...
See, he does this to me all the time. And he wonders why I have a go in when he's not here.
Talks about the 60s and 70s. We were only just born in the 70s.
I don't think I was born.
Go on, what's the question?
Okay.
What's the question?
So, obviously, using equity to go and fund your lifestyle isn't seen as a good thing.
No.
But technically, if you buy a property for $500,000, it rises to $1 million. If you went and sold it, paid the agent's fees and the tax, it would be fairly normal to go and spend that money. Even though you've obviously got a vested interest to get people to sell properties as a rental thing, or sorry, as a real estate agent, it still makes a reasonable amount of mathematical sense. Is don't blow all of your equity, but if you go and spend 5 or 10% of it and you still keep the property, which still grows, it's not necessarily a bad thing, is it?
You've got to stay there. I mean, it's hard. Everybody's talking about how hard it is to get into the marketplace, let alone being in there and then selling and moving out. That's the worst thing you could do. But the issue of borrowing and the issue of borrowing against property, the way it is today, is going to change the face of investing. When I started investing, I would borrow 100% if I could. If I understood the marketplace and the changes, and those sorts of days are gone. So a lot of people that want to take risks won't be able to take the risks that they could have taken. So, maybe funding their lifestyles away. There's a lot of people with equity now who should be at retirement stage. They need to probably get some of the equity there and go and have a break, but I don't recommend it for people in their 20s, 30s, 40s with their first or second properties. Stay there.
So, look, it certainly is a changing time out there, and interest rates will be rising sometimes in the future. So using your equity to fund your lifestyle is a dangerous thing, but it is possible, and if there's a will, there's a way. Now, to get more details around that, you can always download a copy of my book. Just go to yourempire.com.au. We do go through it, but definitely go and get some advice from a mortgage broker, an accountant, or maybe a financial planner. If you've got a question, send us some details to chris@yourempire.com.au, and we'll try and answer all the questions. Charles, auction clearance rates. We're right into February. We've got to be in the heart of it by now.
How did Tom go? Was it great for him? Because I think it must have been, based on what I saw.
We didn't talk about auctions with Tom.
Oh, you didn't?
No.
Okay, no, they were 76.6 on a national basis, but this time last year was 72.3, slightly up. The best one was really Sydney again, 84.8%, and that wasn't followed by Melbourne, and it wasn't followed by Adelaide. It was followed by Canberra at 80%. So there you go. Melbourne came in at 75.4%. But they're all very, very healthy clearance rates still. But the good thing is that there's a movement. There is a change occurring, and some agents and some sellers are putting their homes on the market before auction date. That's an indication that there's a bit of nervousness out there.
Now, we always get a few comments from the viewers that we're always talking about Sydney and Melbourne. Effie tipped Hobart today, and you're saying highest clearance rates at Canberra. So at least we're trying to cover everyone.
We are.
We're doing what we can.
Yeah. Leave Sydney, leave Melbourne, get out to Canberra and Hobart. I mean, I like Hobart too as an investment area, but as one area where there's a lot of investing because there's a lot of promotion and the prices are right, and then you get that tipping point where too many people get down there and all of a sudden your vacancy rates climb. So it's a danger zone from that perspective.
So homes advertised for sale. There's no stock on the market. Where is the stock, and is there more coming on?
Last week was good. It was up 6.03% last week, which is a big climb, but that's based on, I guess, seasons. But 2.71% over this time last week. So that is a good movement. Now, if I can still see that next week, start seeing those percentages, because we used to talk in terms of 0.075% increase week over week. So if we can start to see the 1%, 2%, and 3% climb, I think that's pretty good. So you can see the charts just jumped up quite radically, and I'd like to see that continue.
So would I, Charles.
Yeah, I know.
If you can make it happen, I'll be very happy.
Doing our best.
Rent price movements.
They're actually up only slightly over this time last week, 0.23%. The best performer was Sydney at 0.54%. But the worst performer, it's interesting what we were talking about with Hobart, that was negative 1.91% over this time last week. But it changes and moves around a bit. So we've got to keep an eye on that. The biggest thing we've got to keep an eye on is the vacancy rates. They're the ones that we watch very, very closely because of where we might recommend investors go.
Well, let's take a look at that graph then,
Oh,
Charles.
what a great idea. What a great intro into that. Those have climbed again, but this is predominantly because of Perth. The Sydney market has been outstripped by Melbourne 2 weeks in a row now. Melbourne was actually, it came in at 1.58% in vacancy rates, and Sydney was at 1.96%. So Perth, 8.19, average of those three, 4.91. We've just got to keep an eye on Perth. But it's a good place to start looking at investing in very, very soon.
Wonderful figures. Thank you, Charles Tarbey.
Yeah.
Effie, good to see you.
Thank
and
you.
we should get you on more often. And just a reminder that on Friday the 24th to the 26th of Feb, there's the Property Expo Melbourne Convention Centre. As I mentioned before, just go to propertybuyexpo.com.au, and if you use Sky News VIP, you'll get them for free. Anyway, until then, I'm Chris Gray. Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.